Welcome back, guys. We're going to be going over this recent rate cut that the Federal Reserve did this past Wednesday. Kirby, we spoke about this many times and even in the class, and the last cut, and I'm going to post this link in the description so everyone can look at it. But the last cut before this cut was right at COVID, coping with COVID-19 2020. 2019 mid-cycle adjustment. Then before that was the 2008 Great Recession. Before that was after the dot-com bubble and 9/11. And then before that, global currency crisis. So we see them cut rates around times that are bad. So with all this in the recent news, what do you see going on, Kirby, and what are your thoughts with everything?
Um, like you talked about the last couple times that there have been a rate cut, it was proceeded to be followed by a recession. Not quote unquote recession, a recession. Like we can go, and usually the rate cuts are, well, the last couple recent rate cuts have been to try to fix the economy after the recession kicked in. I mean, if you talk about COVID, they cut rates I don't know, March, April of 2020. That was right at the time the US was shutting down because, all the other countries was already started shutting down, but that's when COVID started being prevalent in the United States. So they cut the rates because businesses had to close down and things like that. Before that, the GFC, Great Financial Crisis, they started cutting rates after, I believe it was 2008. That's when they started cutting rates. And we didn't see a bottom to 2009 in the stock market, but the impact lasted well into 2011, 2012. Um, yeah, rate cuts can be a thing that, is a precursor to a recession. I believe of the past 10 rate cuts, it's only one time in US history that the recession didn't happen within a 150-day time frame from the rates being cut. But the thing is, I see a lot of misnomers out there that people think that the the Federal Reserve, controls the mortgage rates. Um, their actions can impact the mortgage rates, but it really doesn't affect the mortgage rates, even though you see it all over TV and the news channels and social media where people saying, oh, the Fed's cutting rates, so the housing market is going down. If we just look at the last few days that passed, uh, the day that the Feds cut rates by 50 basis points, the mortgage rate actually went up that day. And then it went down like 1 basis point the day after on the Friday. So just giving people just a view of what a yield curve should look like. And I'm gonna have to share my screen here. Let me know when you can see it.
Yep.
All right, so this right here, this is what a normal rate curve look like. A normal rate curve, and this is how it should look. I mean, the shorter term duration that you borrow money, the lower the interest should be. The longer term duration you borrow money, the higher the interest rate should be, because it should be higher for the longer duration because the risk of non-payment is higher. That's why you pay more. But in the shorter terms, this is how it should look. Uh, but recently, over the past couple of years, we've been getting one of these numbers here, where the interest rate yield curve here has been on the shorter duration has been higher. And the shorter duration is what the Fed controls, the shorter duration. And they're trying to bring down this here, they're trying to bring down the shorter term interest rates so it can supersede the longer term duration. So we've been having inverted yield curves. We didn't had, interest rates in the short term higher than in the mid term, the 7 to 10 year, and then it'll come back up a little bit further. But this is currently the situation we're at. We're back in the normal yield curve now. And just to give people, just a visual of what's going on. So the Federal Reserve is trying to bring down the short end of the yield curve. But with that, I mean, will it have some impact on the 30-year bonds, 10-year bonds, 20-year bonds. Uh, yeah, it will have some impact on that, but it will not 100% affect the mortgage rates. For the people that don't know out there, the mortgage rates are controlled by the 10-year treasury, not the 30-year, not the 20-year. It's the 10-year treasury. Whatever interest rate is at the 10-year treasury, because that's really like equilibrium, the 10-year treasury, and then the banks or the lending offices put a spread, and I believe Friday, uh, September 20th, 2024, the spread was about 246 basis points on top of what the 10-year treasury is. And then that's the mortgage rate. I mean, a little bit higher for conventional loans, a little bit lower for FHA, VA loans, a little bit lower for 15-year fixed rate debt, a little lower or a little higher for uh, ARM loans. But that's how your mortgage rate is figured out. And the Fed does not manipulate the 10-year treasury. The 10-year treasury is based on supply and demand or euphoria and fear. So when people think that the United States is going into a recession, they will buy more bonds. They will buy more bonds, which means the interest rate yield will go up. Or say that in the inverse. They will sell bonds because they think that we're going there. Then the interest rate goes up because the price of the bond is going down. And then that's what causes the higher interest rate. So just understand how that dynamic flows. So the interest rate itself is based on supply and demand or fear. The more fear there is, the more likely is recession, the more people are going to go into safe havens. The more euphoric it is, the more people are not going to buy bonds, or they probably sell some bonds to go do other things, take on more risk assets, and then the the yield goes higher. The yield goes higher, then the mortgage rates go higher, and what have you, and so forth. So just understanding that dynamic of it. But Alex, what other questions you got on it?
So I was reading a few points where they were speaking of seeing two more rate cuts in the near future. I think it was from now to, I don't know if, can't remember if it was 2025 or 2026, but do you see those rate cuts happening as well? Or is that more so just rumors in the mist?
The Fed dot plot. And that's just a survey that they have with the feds. And survey the CNBC, Bloomberg News. They do with different economic forecasters. They're saying that it'll be another 50 basis point rate cut, and then they said by the end of 2024. So they're expecting another rate cut maybe in November and then again in December. So 25 basis points apiece will give you a 50 basis rate cut on top of that. And that's just what the market sees right now and what people see, what they're forecasting in the future. Will the Feds do it? I mean, a lot of people way smarter than me, they forecasted that the Feds was going to cut it 50 basis points. I thought it was going to be 25 uh, at the most, but it was 50. And then they're saying that two more rate cuts could come. Is it possible? Yeah, they could. They could. But if we moving down 1 percentage point or 100 basis points in a 4 year and let's say a 4 month period, then it's a lot of other underlying things going on in the economy that we, citizens don't have the data to, that the Fed know about, that they see coming on the horizon, that could put us in a pretty good economic chokehold for a minute. But as Jerome Powell talked about during the announcement of this rate cut, he said he see that the employment the employment cycle is softening. More layoffs, more furloughs, and then if you paid attention to the news, Boeing is going on strike right now. They're furloughing workers. I just seen today that GM, no, Stellantis and Ford workers at a battery plant or something like that is planning on going on strike again. So it's a lot of softening going on. You're starting to see companies do the reverse fire, meaning making people mandatory come back into the office, which they will end up quitting. So it don't look like the company's firing people, but they're making it mandatory to come back into the office. Amazon just did that. More companies will follow and do that. So the companies don't look like the bad guys saying they're firing people. We just they're gonna say they just updated their company policy and people chose not to follow along with that plan. And if you think about it, a lot of these people that was strictly remote or strictly work from home, they probably moved into lower lower cost of living areas, and then now for them to come back into the office every day, they would have to sell their home and then move back to a higher cost of living area. So some people will just pivot and just say, no, I'm not doing it because the cost will be too much. The cost savings that they saved from moving to the lower cost area, it wasn't like they were saving that money sitting to the side. They, when went off and did other things with it, and then now they're, life creep happened, and now they can't afford to go back and live in a high cost of living area with all the other instruments and attachments that they've added on to their life. So, so there will be a lot of things that you'll see in the employment realm, the economic realm that will change. And of course, the Feds have eyes on this stuff way before we as the citizens do. So they're probably adjusting or overcorrecting or correcting more than we expect them to because they see things that we just don't have eyes on yet.
So another question I have is, so we've seen the videos come out on like big real estate guys like Grant Cardone talking about what they foresee coming in 2026, where they expect some kind of rent boom, housing prices going up, rents going up. Do you, if what they're saying is correct, would this be the beginning stages to what would affect or cause that 2 years from now?
I have no insight or color on the conversation that those gentlemen or real estate gurus have. I haven't seen the videos, but just basing off the knowledge that I have with real estate and things like that, yes, it's very possible. It only take another stimulus package and rents are going up. The key of rent is about supply and demand. If more people lose their homes, they still got to have somewhere to live. The demand for rents will go higher. And then I remember everybody was when interest rates was at 8% in the housing market, everybody was like, oh, when interest rates come down, I'm going to buy. But they didn't save that money for the down payment. And then, of course, now you got the Realtors Association issue where now you got to pay for your own realtor and things like that. They don't have the money sent to the side for it. So the interest rates has come down. The interest rates was at 8%. Now it's at 6%. The demand for housing hasn't increased. Only thing that has increased is the supply. So more investors, the people that's going to be in the market now, where people still waiting on the sidelines, waiting for 4% mortgage rates and 3% mortgage rates, it's going to be the investors that's going to come in and swoop up the properties. So that just takes more homes that people can buy to live in off the market. And then, so that means the supply is still tight, demand will increase higher, especially if people start losing their jobs. People will have to downsize, they'll have to sell their homes. They're going to lose in short sales foreclosures, but they still need a place to live. So, guess what they're going to do? They're going to rent. So, demand will be higher. If more demand, you have to raise rents to get the tenants in there. And that's just what happens. So, yes, I can see rents going higher. I can see the rents going higher either president, whoever's get elected, say, "Oh, we got to stimulate the economy because the economy is bad." So they, pump some more stimulus money in there. You saw how fast the rents raised during COVID. You see how the investors came in and swooped up a lot of these properties. So, yeah, it can still give a great boom to investors out there.
So another question I have, and sorry for so many questions, but
Oh
with
no, you got.
people that bought uh, properties and houses with 7% interest rates and this recent rate cut, and I think you put out on the Discord that 30-year mortgages on FHA are at 5.75% right now. With more rate cuts on the horizon and the questions of what that could do to mortgage rates as well, would you suggest, or if people are looking to refinance their home from a 7 to whatever we have right now or what may come, should they hold off and wait until further rate cuts, or is what we're seeing now feasible or attractive?
Uh, I say if you see a rate that you like, you take advantage of it. I mean, you can sit there and play the game of, oh, well, we're gonna hope for a 4%, 4.5% mortgage rate. What if we don't get there and the mortgage rates start increasing? You got to take advantage of what you see. If you had a 7.25 and you could bring it down to a 5.75, you should be doing it right now. I mean, yeah, it can go down to 5.50, but I'm not seeing a four handle at all in the mortgage rate. I'm not seeing that at all. But if you at 7.5, 7.25, and you can bring it down to a five, that's 200 basis points. You got to take advantage of that. That's for, depending on the price of your house, that could be $400 to $800 a month in savings. What are we talking about? But you want to sit here and play this game, and you hear it all the time, especially in the stock market. Oh, I can't wait till the stock market go down, and then the stock market go down, and you miss the boat because you waiting for the news to tell you the market's at an all-time low, and then you missed the boat, and then next thing you know, the stock took off and you missed it. You have to take advantage of what you see. Sitting here trying to do the timing and all that, you see a rate right here that will be advantageous to your life. Take advantage of it now. I mean, everybody's saying, oh, the Fed's lowering the rate. The Fed just lowered the rate, and the mortgage rate actually ticked up. So, see, if people actually paid attention and not waited on the news to give them their information, they would have seen that the mortgage rates have went from 8% down to 6% before any Fed rate cut. Because again, the Fed doesn't control that aspect of the mortgage market. They don't affect it. It's all about supply and demand of the 10-year treasury. The 10-year treasury has went from 4.35 down to 3.75. I don't even know where it's at today. Let me look and see where it's at today because I haven't even looked. Let me see. It's like, yeah. So it was close. It's at 3.75, 3.741. So that's why the mortgage rates went down, not because of the Fed. And that's what people are waiting on. People are waiting for the news to tell them. But if they paid attention, 200 basis points already came off the mortgage rate before any Fed intervention at all. Take advantage of what you see right now, because it could be the Fed drop rates, drop rates, drop rates, and the next thing you know, oh, quote unquote, we're in a recession, right? Let's say we in a recession, fear comes, interest rates drop, but then now the regulatory environment and banks don't want to deal with people because they're scared that they won't be able to finance their home because they might lose a job. They make the regulatory hurdles harder for people to get loans and stuff like that. So you got to take advantage when you can. And another aspect of this whole refi thing, and oh, we have equity in our homes and we want to take out money from our homes. I would just be refining to get a lower rate. I would refi to get a lower rate. I mean, if you can keep the same amount of years, great. But usually it restarts 30 years. But the other aspect of it is you have to have that money to do the refi. Those closing costs still gonna cost you. You're gonna pay, between $8,000 to $12,000 depending on the price of your home. I'm talking about the middle class people, $8,000 to $12,000 to refinance it. And a simple rule of thumb, when you refinance, it should take you, if you're doing the math correctly, the amount of money that you're paying for the refi and the money that you're going to save on the mortgage payments, it should take you, I say 2.5 or less time, 2.5 years or less to get all that money back. That means it's a great rate. So just in this example, if people bought it at, 7 point, let's say a 7.5 interest rate, and they just dropped it 200 basis point, they save $600. It's going to cost them, let's say, $11,000 to refinance, right? So 6,000, let's say $600 a month savings times 12 is
7,200.
7,200 times 2 years. That's
It's over 14,000.
14,400. So it meets the guidelines of being able to refinance. So you should be taking advantage of it. That's just how I look at it. I'm not about timing the market and I want it at the absolute lowest interest rate possible because you don't know when it is. And then by the time you get all your ducks in a row to do it, to lock in the rate and do all that stuff, it might be higher than it is now, and then you panicking because you missed out on a boat of a great opportunity right now to refinance and save money.
Yeah, those are good points. With all that being said, guys, if you have any questions, any further questions that I may have missed, let us know in the comment section. We'll answer them. Don't forget to like this video, share, and subscribe, and we'll see you guys on the next one.